Okay, hello and welcome again from Phoenixville Public Library to our third and final part of the Wealth Confidence series presented by Creative Capital Wealth Management Group. We're pleased to have back Liam McIntyre for our third presentation called The New Frontier of Investing, in which he'll talk about some innovative investment opportunities that are out there. Liam will give you opportunities to ask questions during the presentation. That time you can feel free to type in the chat or unmute, whichever you'd like. Liam, welcome. Take it away again.
Excellent. Thank you all for joining me. My one brave in-personer here at the library who's been with us since the beginning. So definitely want to thank you for coming back here in person, and for everyone on Zoom. Hopefully, had some nice time watching the Phillies, and now we can start learning the frontier of new investing. So I'm very glad to have you all with me here. So the new frontier, what does this mean? And really, it's going to be something that my firm that I work for, Creative Capital Wealth Management Group, we sort of have a very unique niche in this space. Because really what we're looking at today are going to be what are called alternative investments. So you may have heard alternative investments before, you may have read some headlines, seen things on social media. So regardless of what you've heard, what I really want to try to do is look at, okay, what are these alternatives? Really, what we're looking at are, most people, and what we were looking at last week, investing in stocks, bonds, ETFs, and mutual funds. These are what we call traditional investments because they are part of the traditional public stock and bond markets. An alternative investment can be something, and there's plenty of them, investments that live outside of these traditional areas, and investments that are outside of traditional stock and bond markets or derivatives thereof. So today, I really had to force myself to narrow it down because I could talk for hours and hours on different alternatives, but today we're going to look at 5 major ones. So the 5 major ones that we're going to look at today are going to be private equity, commodities, and multiple commodities out there, but I want to focus for today on just oil and gas. If you read news and headlines, oil and gas right now is very big, so I want to touch on that. The third area that I want to look at today is infrastructure, becoming more popular now as well. 4, I want to look at some real estate as an alternative. And then 5, because one of my coworkers, I'm not big into cryptocurrency, I hold a very small amount, but I work with someone who's a big crypto guy, and so he was pushing me to add a section into the presentation. So we'll do a 5th section, a small section on cryptocurrency, but those are going to be really the 5 major alternatives that we dive into today. So, before we jump into the new frontier, I want to explain a little bit of what the old frontier is. So alternative investments were typically and historically limited, and they were only available to one of these 3 types of institutions or people. So first, in terms of who could get access to nice private equity, good infrastructure, good real estate, the first that we're going to see are institutions. And so these are likely going to be pension funds, endowments, sovereign wealth funds, where you can invest millions and sometimes billions at a time. They have investment managers that manage their portfolio over decades, and they have decades of access to these types of alternatives. So the first is going to be institutions. The second are going to be high net worth families. So these are going to be more ultra wealthy individuals. Think your Jeff Bezos types who have millions and billions. They may even have what's called a family office. So you get to a certain level of wealth, and your family gets to a certain level of wealth, where potentially you may need one office to manage your wealth and your family's wealth. So these individuals and their family offices also had a lot of access to alternatives. And finally, for the individual investor, the SEC came out with something called accreditation, where there were certain investments to even invest in, you had to be what's called an accredited investor. And typically this is something that you would have to have your accountant or your CPA sign off on, because there's going to be some rules for an accredited investor. Typically you're earning $200,000 at least a year and have been for at least 2 years. or you can go by net worth. Typically the net worth is around 1 million in net worth, not including your primary residence. But it was, again, just another barrier to most people, set by the SEC, and it's still, today, still a barrier for most everyday investors. So that was the old frontier. Again, the world of alternative investments, the cool private equity, venture capital, hedge funds, only available to the big players. And now we're going to look at some opportunities and areas where people like you and me and everyone at home can still get access to these asset classes. So the landscape has changed dramatically. And I've been, prior to where I was now at Creative Capital, I worked at Vanguard, and working at Vanguard, I knew mutual funds and I knew ETFs. So I knew the traditional stuff, and only once I started working at Creative Capital and working with clients there and our book of business, where you now have access to alternatives, this is something that I started getting into 2 years ago and still learning myself. But even in the small amount of time I've been there, I've seen things come out, and that's changing the landscape. So there's new investment structures that are coming out, and a few things that are making this possible, and I'm going to present a few of them today. But the first structure is going to be what's called an interval fund. So I want you to think of this as a mutual fund. It acts very similar. They are registered with the SEC. They are publicly traded. But the reason they're called interval funds is typically, if you were to invest, and let's just say you wanted to sell and get your money out, you would only be able to do so at intervals. So typically these funds offer quarterly liquidity, because still within these funds are going to be private alternative investments. So things like private companies, private real estate. It's not always as simple of saying, hey, I'd like $5,000 from my investment. We're not in the public stock market. We're not in the public bond market where there's liquidity. So sometimes the underlying assets, if they're in the private space, you're going to face some illiquidity. But at the very least, with these interval style funds, you can still get money out, but it's typically going to be on a quarterly basis. You wouldn't be able to get the money out at will. Moving on, and one thing that we were looking at last week as well, where these are now going to be more liquid investments. These are going to be your exchange-traded funds. So more and more funds are coming out where they may trade, like an exchange fund. They may trade like a stock, but in the portfolio are access to these private assets. So one that we're going to go through today is the one I chose for the cryptocurrency Bitcoin. So there was a Bitcoin ETF that was released by BlackRock very recently, so we'll run through a little bit of what that structure is. And then finally, we're going to look at some online platforms. So the one that I chose for today is a platform called Fundrise, and it is essentially a place where retail investors, you can get in for as little as $10, because what they're going to do is they're going to pool your money with other investors, and through their platform, they're able to invest in private real estate for you. And I'm going to stop there just in case, because we're going to start getting into some examples of what these look like. But before I do, I want to make sure any questions, either in person or if you're on Zoom, you can put it in the chat, or if you want to unmute and talk. I'll just give us some time here if we have any questions. All right. If we have time at the end, I'll always try to do questions at the end as well. So if something comes to you, just jot it down. And you can either ask at the next break, or we can save some time at the end if we have time. All right. Now, for my compliance department, before I was able to walk in here, I had to add this disclosure to the PowerPoint, because we are going to talk through some very specific investments. But definitely want to just know that this is going to be for educational purposes only. Nothing that I talk through or present should be considered financial, investment, legal, or tax advice. The information is going to be for general education purposes only. And for all of these investments, whether they're, we're looking at a public interval fund or we're still looking at a true private, equity or private investment, all investments that we're going to talk about today are going to carry risk, including potentially the potential loss of your principal. And always when you're looking through, I'm going to give you some resources where you can read up some more on these investments as well. There is going to be some performance data, stated, but always know past performance is no indication of any future results. And as always, please consult a qualified advisor before making any investment decision. All right, that's from my compliance department. All right, the first major alternative investment that I want to dive into today is going to be in private equity. So I consider this more of the hidden opportunity, and it's been locked for a long time. So the private market is enormous. So really, right now, and this was from a study and a paper done by Apollo, which is one of the top alternative investment firms in the country. Right now, 87% of U.S. companies with over 100 million in revenue are still privately held. So that means when we look at an ETF or a mutual fund and it says total U.S. stock market, and you're looking at your investment and you're thinking, wow, I have all of the U.S. stocks in the market. Not necessarily. You have all of the public ones, but for the public ones, you have a lot more private ones. Some trends that we've seen recently, public companies and IPOs, initial public offerings, have been declining almost exponentially since their peak in the 1990s. Why? Because companies are staying private for longer. And a few reasons for that. One is hearing from sponsors, the IPO process and the funds that it takes to have an IPO is getting very long and arduous. And companies are still, even if they're private, they're getting good valuations, they're still making money, and they're thinking, well, if I don't want to go through this bureaucratic process of listing on an exchange, why don't I just stay private and continue to build my wealth from there? So some companies right now are just deciding, we're just not going to do the IPO. It's not the market for it, and I'd just rather stay private for longer. We've seen that trend, been continuing recently. But also realize, why does a company go public? Likely at that point they're be well established, they have good cash flow, they have good management in place, but all of that value, once they click over into the public market, that growth may have already happened, from the ground up. Think about what Amazon was like, when it was still in Bezos' garage. Having that growth of being in the very early stages versus what we might have with Amazon now. Again, that private space is still going to be a place where a lot of growth can happen. So why does this matter to you? You have your 401k, you have a brokerage account, you have your, whatever you have, and you have the total U.S. stock market. Really, if you're still in those traditional investments, you're really only seeing 13% of the opportunity. You're not able to, potentially tap into that private side of the U.S. market. So, for example, private equity. A pool of capital is essentially raised from investors, and it's going to be a way that the sponsor can invest directly in private companies. And how do returns come? Well, returns come when the company grows. They receive higher valuations. That company may be bought or by someone else, or that company goes public. On the old frontier side, we're going to see a few structures. First, we're going to see what are called Reg D funds. So when you see the term Reg D, I want you to think accredited. So these are funds that are only going to be, in their prospectus and the rules, you can only invest in them if you are an accredited investor. They're usually fully private, and they still carry for now very high minimums, sometimes as much as $100,000. You could have what's called a fund of funds. This is more diversified, so it's a manager that picks multiple private equity funds, and it's going to bundle them into one sort of fund of fund structure. It's more diversified, but it does add a layer of complexity and definitely fees. Or if you have the money and you have the access, let's just say you might not even need a fund. You want to buy a business that's private and you have the funds for it, you may just be able to make a direct investment into that business. So for some of us saying, okay, well, I need $100,000 right now to invest in this private equity, I don't have that. I definitely don't have that. I don't know if anyone else here has that, but that barrier to entry for everyday investors is what we're trying to get you through. So, for example, we're going to look at what's called the private shares fund. This is an interval fund. So again, this is going to be trading like a mutual fund. It has a ticker like a mutual fund. You can find it on some brokerage platforms. But realize the interval structure of it, the illiquidity of it. So we can invest in it. If you ever needed to take the money out or take your gains, what have you, you would only be able to do so on a quarterly basis. But what this fund does is it invests in shares of venture-backed, pre-IPO, and late-stage private companies. So what this fund does, and right now in the portfolio, major names right now, SpaceX, XAI, Discord, these companies offer their employees shares, but they're private. And really, if you're looking at an employee, I have all this, let's just say I work at SpaceX, I have these private shares. There's no market, how am I getting any cash for these shares? They're just sitting there. So what this fund does is, and it goes through a number of channels, but they can purchase the shares directly from employees to give them some liquidity, and now that fund holds the shares of the private company. So, right now we have the private shares fund. It is, again, it trades like a public mutual fund, but within the portfolio itself, you have access to major names right now, SpaceX, XAI, and Discord. Major headlines this year, Musk positioning potentially SpaceX for an IPO. Same thing with XAI. So really, this is the exact thesis of the fund, which is they want to hold those pre-IPO, late stage. These aren't, baby companies. They're not just starting out. These are, pretty well established, almost at the point of IPO. And then what happens? Let's just say, for example, SpaceX has that IPO. The shares that the fund has are now public. They're able to then return some cash to investors, and then they'll, be able to use potentially the cash as well to find the next private holding that's going to be pre-IPO. I left the website there, so if you ever wanted to read up on the fund or just read some more information about it, it's just going to be privatesharesfund.com. It may have a whole bunch of information, but definitely key risks that we want you to understand. Valuation. So private companies are not priced daily. So if you're not in the stock market and you're not beholden to the public listing, you do not have to give your valuation daily. So typically they do go through valuations, but it's not going to be on a daily basis. So whether the company is doing really well or doing really poorly, you may not be able to know until months and potentially a year after a new valuation comes out. So always understand there's going to be some valuation risk. Concentration. You're going to have heavy exposure to a few large private companies. So for a fund like this, where it's very specific, again, it's going to have really cool names, SpaceX, XAI, Discord, but it's going to be that exposure, that concentration that you want to look out for. And just because the fund has the company in its portfolio, that does not mean it's guaranteed an IPO. Elon Musk could turn around tomorrow and say, I'm never taking SpaceX public, and there would be nothing that the fund would be able to do about it. So realize this is what they're targeting, but just because you see the company in the portfolio does not mean there's going to be a guarantee of an IPO. All right, next. I want to look at one example of a commodity, and I want to focus on oil and gas. This was something that I had absolutely no knowledge of just 2 years ago, and it's something it's a unique feature of an investment like this, and it may, potentially, depending on your income, may benefit you. So what I'm going to go through is for oil and gas right now, the partnerships and the interest that you can purchase right now, oil and gas, what you can get access to is primarily still mostly limited to accredited investors. And why is the reason? So, for high income individuals, oil and gas investments can potentially be a huge benefit. In oil and gas investing, you have what are called intangible drilling costs. So this is the cost of the machines getting into the ground, drilling up the oil, depletion in the ground, depletion in the equipment itself. So what happens is the IRS code allows for what are called intangible drilling costs, meaning you can deduct sometimes up to 65 to 80% of those drilling costs immediately in the year that you invest. So it's essentially a way to buy a tax deduction. So for example, if I had $100,000 that I wanted to invest in an oil and gas partnership, if that partnership offers an 80% IDC deduction, I would be able to deduct $80,000 from my income for that year. In addition, oil and gas is typically a very long income stream, potentially, and every year there is additional depletion. So a portion of that income every year, once the oil comes out of the ground, the income that comes back to you may potentially be a portion of it tax-free. And this is, if you think about it, similar to every year they allow a level of depreciation on real estate. It's sort of similar in terms of oil and gas, where the income you're receiving, a part of it may be considered depleted and is not taxed. Royalties and working interest. So sometimes oil wells, they can last for sometimes as long as 30 years. So when I have clients that are looking at investing in oil and gas, I always try to say, you're buying an income stream. If I put $100,000 in an oil and gas partnership, I may not be able to turn around in a year and say, well, I'd actually like $10,000 back, please. It's not how that works. You're buying a long income stream with that investment. So, again, key risks, commodity price, so the price of oil, right now, and I've talked with a few oil and gas sponsors, and there's sort of this frenzy, now oil has shot up in price, and everyone thinks, the oil and gas guys are celebrating. Not necessarily. So that commodity price can come right back down. So just know that, even oil prices, much like stock prices, can go up, they can go down. Environmental liability and some government risk, if there's ever any legislation that may impact the oil industry. Illiquidity, which is what I just was explaining. I buy oil and gas interest for $100,000. I can't normally turn around and say, hey, could I have $20,000 back? I have to wait for that income to pay me out. And just because you invest in an oil and gas partnership, wells may underperform. The driller may say, nope, I know exactly where to drill, I know where the oil is, let's get down in there. They drill the hole and the well is dry, or there's less oil than they thought was going to be there. So even some oil and gas partnerships can also be speculative. There's no guarantee that the well will be able to perform. All right, next area that I want to look at, infrastructure. So when you hear infrastructure, I want you to think about roads, bridges, airports, power plants, cell towers, data centers, railway, utilities, really anything that is the physical and digital system that keeps the economy running. Right now, three major forces driving infrastructure investment. One, definitely surging energy demand. Two, the digital revolution. So behind the headlines of the AI craze and the ChatGPT and the Anthropic, all of that AI build out takes massive amounts of energy. And really what we're looking at is what is the infrastructure behind that that's going to be able to allow those systems to be able to really reach their potential. So we have surging energy demand. We have the digital revolution, definitely driven by the AI investment right now. And then finally, it's going to be the boring stuff. It's going to be the roads and bridges that are aging. And America has a ton of aging infrastructure. So I think, I forget what it's like the engineers, there's an engineering group, and they go around and they rate, essentially they grade like A, B, C, D, E, like you were in grade school. They grade the infrastructure of different countries around the world. And I believe America right now is sitting at a C- for our infrastructure. So definitely in terms of our roads and bridges, anyone in Pennsylvania, gotta love the potholes. So definitely infrastructure could use some work. But let's just say over the next 10 years, right now there's about a 2.6 trillion infrastructure spending gap. And really when we're looking at an investment of this size, government spending alone is not going to be enough to fill that gap. So really that's where the private capital right now is really becoming essential to be able to fill that gap and invest in America's infrastructure. So we have a similar structure to what we were looking at in the private shares fund. So this is, again, an interval fund. So it is the Cantor Fitzgerald Infrastructure Fund. Still public, and it's going to allow retail investors like yourselves access to these types of infrastructure assets. And the three areas that I mentioned earlier, so you have digital transformation, aging infrastructure, and energy demand. Those are the three focus areas that the team at Cantor looks for in their portfolio. So they're investing in energy systems, in transportation, in digital infrastructure, and utilities. And the portfolio it's unique because in this structure you get a little bit of a mix of both public side of infrastructure. So a part of the portfolio is going to be just in public infrastructure related stocks, so energy companies, utility companies, and that's really where a lot of the liquidity of the fund comes in because you have a public sleeve. So part of that portfolio is going to be in public stocks, but now we're getting into the rest of the portfolio, which it gives you access to private infrastructure deals and projects. So looking at the portfolio now, again, you're going to have within this one fund access to both the public and private side of infrastructure. And really when you're looking at the private projects in it, you're looking at those institutional style projects. So right now, one of the top holdings, at least on the private side for the fund, is Blackstone. So Blackstone, a major name in the private alternative space. So really you're thinking about investing right alongside those major institutional names with this fund that you can buy. Definitely want to hammer home, again, some of the risks. Again, interval fund, quarterly redemptions only. And the other thing that I want to mention is, okay, so they offer you the liquidity on a quarterly basis. Usually each fund has a cap. So they say, every quarter we can only release as much as 5% of the fund's assets because they have to keep some stability in the fund. So even if you submitted a redemption request on a quarterly basis, it's not necessarily that you're going to get the full amount or any amount at all, because again, there could be some caps you might face. So always want to be sure that when you're looking at this, you're realizing the illiquidity, making sure that you're able to stay in this long term. Second is going to be regulatory risk, of course. So infrastructure, regardless of Republican, Democrat, always in the policy discussions. So it's always subject to policy changes, depending on what the administrations are focusing on. And these projects are also very sensitive to interest rates, so how the administration is setting interest rates as well. And finally, especially for this fund, this is going to be an actively managed fund, and these are managers that are now juggling both the public and private side of infrastructure. So you're going to see fees going to be much higher than if you were just investing in a passive index. And I'll stop there. So we've been through 3 so far. I will stop if you had any questions on any of the investments we were looking at before, or right now on infrastructure. I'll just give some time if we wanted to have a question or two. Good. And I did leave as well. So again, these funds are all publicly listed. They have a website, so I left the URL for the Cantor Infrastructure Fund there as well. All right. Next, we're going to move in to one of those online platforms. And the one that I wanted to look at today is going to be a platform called Fundrise. And this is a way to get access to private real estate. And their minimum investment, I was looking on their site, you can start at their base level account with something as little as $10. So what is Fundrise doing? So Fundrise is an online platform, and what they're doing is they are essentially pooling investors' money, and with that money they are able to act like an institutional investor. So they're raising tens of thousands, sometimes millions of dollars at a time, and with that money they're able to invest in different private real estate projects, and sometimes directly into the real estate themselves. And they're targeting real estate. You're looking at things like apartment buildings, industrial properties, single-family rentals all across the United States. So a few things for real estate. Yes, real estate, we're looking at it for, ideally value appreciation. I want to have the real estate grow in value so that my investment also grows. But another major benefit of real estate is income. So you're looking at, single-family rentals or apartment buildings. Those are cash-flowing assets. So really what you're looking at for real estate is also the income potential. So right now, Fundrise, they give out quarterly distributions, and that's going to be paid to you essentially like a dividend. And you can either take that cash and, again, that's going to be cash coming back to you, or they could do something like a reinvestment, where if you just wanted to take that cash and put it back into your Fundrise account, you would be able to reinvest. So in a way, it acts like a stock or an ETF where you might be able to reinvest your dividends. This is going to act very similar. And this is fully digital. So it is an online platform. It's a way that you don't have to go to your advisor to explain to you about real estate. You don't have to go into a bank. Really, you can manage your real estate portfolio right from your phone or your computer. And I have looked, I don't have Fundrise myself. I've looked into the platform multiple times. Once you invest, typically what they'll do is they will actually show you what the real estate project's in or the real estate building in that you are invested in. And you'll have that fractional ownership. So very much like your investment portfolio, even in Fundrise, you'll be able to see exactly where you're invested. The illiquidity of this is going to be a little bit different. So redemptions, they do offer their investors liquidity just in case you needed to, take the money out. But again, realize you're investing in real estate. You're investing in commercial properties, apartment buildings, industrial properties. It's not always as simple of, I need money tomorrow, let me just pull my money out. So they will take redemption requests, and then they have to work with their team to get some liquidity out of the deals. Just know that oftentimes does not happen overnight, because again, you're dealing with illiquid real estate assets. So again, illiquidity, even if you needed to take the money out, just know it may be days, sometimes even weeks, for that money to come back to you. Real estate market risk. Again, property values can decline, much like a stock price. Even real estate, since 2024, a lot of equity in real estate had a big downturn. The interest rate spike, for almost a decade, interest rates were at near zero. In 2023, 2024, they spiked up to almost 4%. And real estate, at least the equity side of real estate, when revaluations occurred and loans were refinanced, it took a big hit on the equity value of real estate. So always know we have some market risk there. Platform risk. Realize that Fundrise is a platform and it's also a private company. If Fundrise goes out of business or the platform fails for whatever reason, just know, again, no guarantee that the money is going to be able to come back to you if the business cannot continue. And I took a look at their fees. So again, it's a different side of investing. It's very unique. It's sometimes very sophisticated. So realize that the management fee on something like this is going to be much higher than if you were just sitting in a broad-based, low-cost index fund. And I want to look at for real estate. Part of the portfolio, if you ever look at it, for real estate there's going to be two sides of real estate. So when I say equity in the real estate, I'm talking about you're owning a piece of that building's valuation. If you were ever looking at, last week when I was saying what's the difference between a stock and a stock is ownership. You are owning a part of that company and you get rewarded when the company grows and has a higher valuation. So think about real estate equity. You're invested in the actual value of the building itself. But there's also a side of the portfolio where it can be in real estate debt or credit. So the builder or the property manager, let's just say either the property is being built, it's being upgraded, it's being redone, and you're giving a loan to the property. That is going to be on the credit side of real estate. So that's going to be more of like the bond compared to the stock, where you're not exactly invested in the valuation of the building. You are now loaning money to the real estate operator, and you're being rewarded with interest. So you have both the equity side of real estate and some real estate debt in there, depending on how they want to invest. And I'll stop there as well. Any questions on the real estate portion, or any questions on any of the investments that we talked through previously? All right. All right, I will dive into it. So last area that I want to go through is going to be in cryptocurrency. There's a lot of cryptocurrencies out there. The one that I'm most familiar with and the one that you've probably either heard of or at least what may have the most exposure to is going to be Bitcoin. So what I want to do is I'm just going to focus on Bitcoin. I may touch on a few others. But I would say, at least in terms of my knowledge and what I have, I would say for a presentation, let me stick to Bitcoin and not dip my toe elsewhere. So, what is Bitcoin? What you're really looking at is a digital currency. And this is a currency that is not issued by a government or a bank. So the cash you have in your wallet, the $20 bills, those are issued by the Treasury. They're issued by the United States government. Same, if you go to another country, the currency of those countries is controlled by a government, whereas Bitcoin is purely digital. And you're thinking of it as code on a network of computers around the world. The blockchain, which is where Bitcoin is housed, think of it like a shared public ledger. And really it is a digital record, a ledger of every Bitcoin transaction ever made. If you ever purchase anything with Bitcoin, that purchase would be on the ledger. So what has been driving Bitcoin's demand? I think it's the retail knowledge and the exposure to Bitcoin. I didn't know about Bitcoin prior to 2020, even though Bitcoin has been around since the early 2000s. So how it works is, again, this is a code on a network, and there are only 21 million of these Bitcoins that will ever exist. So there is a fixed supply. Unlike the $20 that you have in your wallet, what can the Treasury do? The Treasury can print money. So the cash you have, governments, they can, at least for the United States, there is almost an unlimited supply of money. If the Fed wants to, Treasury wants to print more, they can go to the printing presses and print more. Whereas Bitcoin, there's only going to be 21 million. It's a fixed supply. You can't make more. Recently, institutional adoption. So we're going to talk about BlackRock. They came out with an ETF where retail investors are going to be able to get access to Bitcoin. Same with Fidelity. So institutional adoption and offerings. You're going to get a lot more firms now offering cryptocurrency-like products, and Bitcoin was probably one of the first out of the gate. So right now, Bitcoin is probably one of the largest ones that has that institutional money backing. The store of value argument, it's being challenged a little bit now, but what you may have heard of Bitcoin is that it's called more of a digital gold. Now why? Because gold is a fixed supply. Only so much gold. It's not easy for me to go out into my lab. I cannot make more gold. There's a fixed supply. So very much like Bitcoin, it's gold, but think about it as digital gold because it's, again, digital, but there's a fixed supply. It's a hedge against inflation, very much like gold, but it's also a way against currency debasement. What that means is what I was talking about, when you're looking at the cash you have in the bank or the cash you have in your wallet, the government can, at will, anytime they want, print more money. Unfortunately, when we think about when I'm printing more money, it's not, oh, look at me, I'm so rich. Oftentimes when you print more money, it actually devalues that currency. So you want to think about, I want to have a way to have currency, I want to have a way to pay, but it's not being debased by inflation or by a government deciding to print money. Right now, we have what are called spot Bitcoin ETFs. What does that mean? So a spot ETF means the fund is going to invest in these assets, so they're going to invest in Bitcoin, and really it's investing so that it will track the price of Bitcoin within the ETF. So Bitcoin has a price. There is a conversion of 1 Bitcoin to a certain dollar amount, and you're going to be able to get that if you don't want to own the Bitcoin itself. You can still track the price of Bitcoin and its potential for growth or loss through this ETF structure. And right now, again, these are very new products, but still the investment in them is just it inflows out the wazoo. So still right now around 128 billion right now in cryptocurrency and spot Bitcoin ETFs, and only launched in 2024. So, what are the ways that you can access it? And definitely want to make sure that you're understanding the risks. So where do you buy? You have Coinbase and other exchanges where you can invest directly in Bitcoin. You can buy the Bitcoin itself. You buy directly, you hold it. It is The platform itself, pretty easy to use. If you've ever traded on a Vanguard or a Fidelity where you're buying an ETF or a mutual fund, it's sort of intuitive like that. But also realize you may have heard some stories of hacks or stealing. If you keep it on the exchange itself, of course it's going to offer its own level of security, but you're also running that risk as well. If you did not want to buy directly from the exchange and you wanted to do something that you are more familiar with, again, you could use that ETF structure. So the iShares Bitcoin Trust is BlackRock's spot Bitcoin ETF. It trades like a stock, so when the stock market is open, you can trade the Bitcoin ETF. You will hold it in a typical brokerage account. You would not necessarily need what's called a crypto wallet. So I'll explain that a little bit. For your cryptocurrency, you can either hold it on the exchange itself, or if you want a little bit more security and control over it, you can establish what's called a wallet. If you've ever put a file on a flash drive and you're taking the file from your computer and putting it on the flash drive, think of that very much like what you can do with your crypto. You can take the crypto from your exchange that you might have on the computer and you can put it into a separate wallet that is not connected to the exchange. One thing that we definitely want to mention is if you do go to the exchanges, fees. So they typically will charge, sometimes up to 2% per transaction. So realize, depending on how you're trading and how often you're trading, those fees could start to add up, especially if you're a frequent trader. So definitely want to be mindful of those types of fees. If you feel that I really want Bitcoin, but I don't want to pay potentially the fee of Coinbase and that trading, potentially the ETF structure might be right for you, because then you're dealing with again, it's trading like a stock. Key risks, and these are just a few of the risks that I wanted to mention, but realize Bitcoin is going to be, or any cryptocurrency, there's going to be some extreme volatility. So ups and downs. So think about for your 2022, you were up 65%, you were down 65%, and only the next year you rose 100%. So Bitcoin is especially not for the faint of heart. You're going to get years of massive performance, followed by years of stomach dropping, oh my god, I cannot believe how much money I lost performance. So extreme volatility right now in Bitcoin, even with the institutional backing. Also realize for the Bitcoin itself, there's no underlying cash flow. There's really, the value is depending entirely on demand and perception. Unlike a company or a stock where you can dive into their financials, you can look at their management team, you can look at their performance, you can see their profit, their loss, and you can make all these determinations about the value of the stock from there. You don't necessarily have that with a cryptocurrency. So the value is based entirely on the market and where the demand is, and where the hype is sometimes, which can get very dangerous sometimes. Regulatory risk. So right now a few cryptocurrency laws are still getting established. Depending on the policies that come out and that get passed, could potentially change how people can access Bitcoin and how it can trade. So just know that regulations can either promote it or shut it down. And then finally, we're dealing with, if you are on the platform or the exchange, there's going to be the risk of that platform failing. One of the major news stories, FTX, was a cryptocurrency exchange. It collapsed in 2022, and basically billions of dollars of people's money were lost after that collapse. So, I want to one more time run through what we looked at today and then just give you my own sort of thoughts in terms of allocation, because we've heard of these things, but then we're thinking of, well, where might these actually fit into my portfolio? So first, we're looking at private equity. Again, most companies right now, around 87% of US companies are still private. Interval funds, like the private shares fund that we looked at, is going to give you access to things like SpaceX and XAI and Discord. So things that are typically private, you are now able to access. Oil and gas, if you're still in that accredited investor territory, could potentially give you some tax advantages if you are in a high income tax bracket and you would like to relieve some of your tax burden. These oil and gas investments could potentially be very beneficial to you. Infrastructure, again, we're looking at critical needs of the country in energy, in the digital build out, in our aging infrastructure to get our roads and bridges up to par. And things like the Cantor Infrastructure Fund is going to bring you really right into those deals themselves, that institutional quality access to infrastructure assets right through that interval fund structure. We have platforms like Fundrise. If you're interested in real estate investment and you don't want to go try to get a down payment on your first apartment complex, you don't have those tens of thousands or sometimes hundreds of thousands of dollars. I want access to real estate for a lower barrier to entry. A platform like Fundrise would be able to give you that access to the real estate sector. And then finally, leading off with Bitcoin. Again, there are others. I would say right now, Bitcoin is probably the top one by market capitalization. Other ones, Ethereum, Solana. Then you have all of the different meme coins, which I heavily suggest you stay away from. But at least for Bitcoin, I want you to think of it like digital gold with a fixed supply. And you can either access it via an exchange like Coinbase or use a spot ETF like avid. Again, any cryptocurrency, even Bitcoin, is going to be high risk, and definitely diversify carefully. So, rules of thumb as we end off the last 5 minutes here. If you're thinking, I like this fund or I like this idea, where might this fit into my portfolio? Again, some of the major risks that we're looking at for all of these investments is that illiquidity. So realize that all of these should potentially be, I want you to think about it, a long-term investment. And for retail investors, again, the institutions, the high net worth individuals, the liquidity is not necessarily top of mind for them. These institutions, these people are investing for generations. They can put all of their money in a private equity and private credit infrastructure because they're going to be around for generations. They don't necessarily need to tap that cash right now. We saw a little bit of a crunch, after the Trump administration started going after institutions like Yale and Harvard, and all of a sudden, some funding was cut off. They had to tap their endowments, and some of them got stuck. Why? Because again, these assets are private. It was not easy to pull money out of them, so they're not designed like that. And unfortunately for people, people are not institutions. They don't have the wherewithal to be able to, withstand that. We have to have liquidity top of mind for investors. So if you need your money and you need to access your money, we want to make sure that money is available to you. So typically when we're looking at a portfolio, how much should I be investing in alternative investments? Right now, rule of thumb is anywhere from 10 to 30% of your portfolio. It is not recommended to throw all of your money or all of your portfolio or even a large portion of your portfolio in an alternative, just in case, again, no guarantee of returns, and definitely that liquidity. If you needed to access that money, you don't want to be locked out. So when you're looking at how much should I invest, and you're looking at your portfolio, again, rule of thumb, anywhere between 10 and 30%. If you get past 30%, it gets a little eyebrow raising, and you want to make sure that you talk with someone and make sure that you fully understand what you're doing. But I would say for most investors, you're looking at an allocation. If you wanted to add alternatives to your portfolio, you're looking at anywhere from 10 to 30%. And now you might think, what's left in my portfolio? I may have 10% to alternatives, I may have 20% to alternatives. Remember, we're looking at building diverse portfolios. So if you ever heard the saying, we don't want to put all of our eggs in one basket. We may have a piece carved out for those alternative investments, but the rest of that is going to be what we talked about last week. We still want to have that traditional exposure to stocks and bonds, to funds, to ETFs. And definitely to some cash or cash equivalent investments. It's going to depend on what your need is, but you're thinking about, if I want a truly diverse portfolio, you're keeping liquidity for retail investors top of mind. We still want to have, again, that money able to be accessed by you. So around 10 to 30% in alternatives, the rest would be in typically traditional assets. And I want to leave you with a few things. So first, again, my company, Creative Capital, that is our niche. Our niche is in alternative investments. Please write down my email if you have any questions. If you would ever, wanted to learn more, you could definitely find some information on our website there. And finally, our CEO and founder, Fred Hubler, he is a contributor for Forbes, and they have him as the writer for pretty much their alternative investment section. And I'll give you a news flash. Many of those articles are ghostwritten by me. So if you would like to read more about alternatives, Forbes.com. Typically every month they give you, if you're not a subscriber, you get anywhere from like 1 to 3 articles a month before they put the firewall up on you. But there's a ton of stuff there. He's been writing there for a few years now. So if you ever wanted to learn more, definitely check out the Forbes page. And I think we have 2 minutes left. If there's any questions, if you want to unmute or put them in the chat, happy to answer.
Anyone on Zoom? Speak now, or forever hold your peace. Okay, got a thank you from Dawn. Okay. Okay.
All right.
Guess they got it. Thank you, Liam.
All right. Well, thank you all for joining me tonight. Hopefully, we have some more nice weather out, and summer's coming. So definitely want to thank you all for joining me today, and take care all.
Okay.